Howdy my friends, nice to see you again. I want to share some thoughts with you. This time,
boom, call the credit spread, the characteristics.
Remember, you can always look up more details on optioncrusader.com and my blog. Also remember, this is one of our first videos. Please forgive us for the imperfection. So what are we looking for in the conditions? So we want to make money when the stock market moves up moderately. Okay, understandable. But I say moderately because we don't want to have spikes. The statistic is on our side. And that's what we always have to keep in mind. So let's continue. So coming back to this point here, we want to make money when the stock market moves up moderately. Okay, that's a key issue here. And we want to make money when the stock market moves sideways. That's a newbie for lots of people because you can actually make easily money in that market condition. I love them. And we want to make money when the market goes down. Well, our position already is a credit spread, so you get the money up front. And when the market turns down, it's just accelerating the deterioration of the trade. The probability of your trade going into green or staying in the green goes up from 50-50 to 90-10 or even 99% success rate, right? So we don't care. When the market goes down, we don't care. It just confirms what we think. If it goes on the side, we make money. If it goes up moderately, the trade will expire and hence we will keep the credit. So that's the whole concept of that trade. So the bear called credit spread, which is a long name. Where does the name come from? The bear is misleading because it says I want the market to go down and I expect the market to go down. As I pointed out, I do not. I expect the market to trade in a range or go down or even goes up moderately to a certain point where I put my strike price, and this is calculated on 2.5 standard deviation, which is a statistical value which puts the odds into your favor. You want to be the bank, so you have to play by odds. You don't have to play by your emotions or what anybody says on the internet, and I will show you exactly how that works. You can follow it, you can make your own numbers, and you will see that I'm right on this one in the long-term statistical development of any trade in this category. So let's see what we have here. We can say that the upward risk is determined and is limited by historical data. So we collect our data from the 5 years period on Yahoo Finances. You can just download it into your spreadsheet. And I do it 5 years on a weekly basis because I only want to have a few data. I don't trade on a minute, 1 hour chart. I just put my odds in and that's it. So I collect data from 5 years on a weekly basis. Then the upward move of the underlying is not a profit hindering development as long as the trend stays in a moderate historical proven pace. I explained this already. So as long as it's going up moderately, we are good. If it goes up like this, like in the last 2 days where it has 2 gaps, I don't like it too much, but we will see. And we have to follow the rules and the statistic will prove me right. And the probability of being taken out in a regular market, I have to emphasize this here, okay? A regular market, which means a moderate development, not the screaming, let's go to the moon, bro, development in the past 6 months or prior to the past 6 months or in the past year, actually. It's a little bit extraordinary and we might have to adjust our levels a little bit, but not too much. But here I said 5%. So I think the win rate is about 90% winners, 10% losers. And here you have it. Let's move on. So take a look at 2 ETFs and compare them statistically. I don't care what people say about ETFs. One thing for sure, you can make any money you want in any vehicle if you understand the vehicle and if you understand your numbers. Buy one share for $10, goes up 10%, like $1. But he says, oh, I'm not making enough money. This share goes up 5%. It's a $20, but it goes up 20%. Makes a $4, right? But you crank up your position, $10 stock. By 10 of them, you have $100. You make a percent on that, you make $100. So you make a $10 profit compared to the $4. It's numbers that do not tell you anything, right? Get rid of it. Do not. This is a stock you need to be in. It's all a scam, okay? They try to suck you in. You provide the liquidity by buying that stock when everybody else, especially the institutional traders, the smart money, getting out. They want you to come in and give them your money. And they dump the rest. They don't even care if 50% of the position comes down or does not make. They get also caught in the downfall, sold 50% in the trend for money. So they have something that is called average costs. They average their costs. They have a huge position. They don't sell them all at the same price. They shit out, come out on top. The position is small, but there are 1,000 small players. They all come in underwater. So that's the whole purpose of this whole trading thing. It's all stacked against you. Don't fool yourself that you have friends in this game. You don't. There are no friends. Wherever you're swimming with sharks, to do bird watching in a lion's country, to serve tea on the battlefield when the shells are falling around you. Just think fancy about it. Get this into your head. No matter what you trade, no matter how much you trade, the system is winning and get an edge you can develop. Right? And that's what I'm talking about. Say, oh, this guy is trading the IWM, the Qs. Fuck, what is that? Like it, move on. We'll show you how. I don't charge anything for it. Care money on it. Why should I charge you for this? Okay. There's more traders who are using the same system. We're not coming even close to one of the big hedge funds. We're not even close to anybody who is trading the big money. So swim with the sharks. You're not just in a shark tank. You have a tree post that you can watch birds in the lion's country. Maybe you're serving tea in the bunker in the battlefield. What I'm talking about, all right? Don't care about what everybody else is doing. It's totally irrelevant.
The 4 major ETFs event.
The characteristics.
There are, in my opinion, okay, the Qs, the IWM, the SPY, and the DIA, Dow Jones Industrial. The SPY is for the Standard & Poor's 500, all right, and the IWM is the Russell 2000 Small Cap US. Qs representing the NASDAQ ETF, okay? So I run them over an Excel sheet, okay? I will go a little bit into it, not in this one because it will just be a distraction. Some people are technically good. Other people, they just don't like it. They want to understand the concept first. So let's go with the concept, okay? The Qs on a weekly base, they usually go up 1.1% and they go down 0.6%. Wow, all right. You have up weeks you're up and you have weeks you're down. Pretty decent, right? Nothing new. Here's the IWM. Goes up in weeks 1.1 like the Qs. Okay, cool. But goes down 9.97. So it's almost 1. And if you can make a math, when this one goes down, it goes down 50% deeper than this one. All right. Let's say this goes up 110 points. Then it goes down by 60 points. This one will almost go 100 points, okay? Goes 110 points up and it goes almost 100 points down. I love it. Why do I love it? It's a range trading, right? It's a volatile. Sure, it's volatile. Let's see why. If you go, here's the DIA and the Standard & Poor's. So they are both pretty much similar, all right? The DIA for the Dow Jones Industrial Index and the SPY, they're pretty similar. Okay, one goes up $85 a piece and goes down $65 a piece. So the downsides is as much as the Qs, but the upside is only 60% of the Qs, all right? What does it tell you? Well, this is a pretty smooth moving big ship, okay? It goes up a little bit more and it goes down a little bit, not so much, yeah? And this ship goes more up, then it goes down. It goes down as the SPY and the DIA, and the IWM is the fastest moving of all. It goes up like the Qs, but goes way more down, right? You see the 65 and the 90. So this is a 50% more down than this one here. And this only goes up like this one goes down. So this is most of all a range trading ETF, okay? So in a sideways movement, I will pick this one. In an upward movement, I will sell put or bull put credit spreads against the Qs in an uptrend. Why? Because the puts will lose so quickly on value that you can buy them back for cheap money and make a profit while this stock is running upwards. All right? You could do the same here, but we will get to this later, okay? So these are just only the basics. What can we see here? Right? You see how nicely I did this here? The average return of all the data I receive is roughly in 5 years. Weekly is 262 data points. Out of this 260 points, I have 160 data points or 160 weeks where the stock goes up 1.8%. So this is the worst case scenario in my equations. If you have the stock going up every week by 1.8% without having a bad week, half a bad week, is just going up. All right. And this is the same for the downside. 99 weeks out of a 5-year data set, you have 1.8% average down. You see that these numbers are pretty much similar. The worst case scenario and the best case scenario, or both, in my opinion, they're both. Well, this is actually the negative return is actually the best case scenario for me, and this here is the worst case scenario because I'm on the other side of the trade, right? As I explained before. So, but since you have 262 weeks as a total, and you put this as a ratio of this here is your average mean return based on all the data. So there is, in 4 weeks, you will have a week that goes down, or 1.5 weeks, this stock is down, right? We saw it. So we saw it right here, right? So this is what I have to take into consideration. And that's what I mean. 1.1% up, 68%, 0.68% down. So that's the average, the mean average over the past 5 years. Why I only take 5 years, not 20 years? Well, I want to give the present a little bit more weight in my data. And when I collect the data from 20 years ago, 10 years ago, the present 2 years, or the past 2 years, they are not so relevant. But I know that the stock market is crazy in the past 2 years, so I want to give this a little bit more weight in my calculation to be more on the safer side, all right? So the range we can see here is almost 1.8% up and down from top to the bottom. That's the Q can swing. The IWM can swing 2%, right? It's a little bit more, right? And they swing less, and this is what it is. This is just a confirmation, the numbers I showed you before. You see 262 weeks, I calculate from everything. I get this data from the Yahoo Finances. I just put it into an Excel spreadsheet, and then I collect data. I filter them. All the weeks positive, all the weeks negative. I get my weeks here. I get the average return. I put this number then in here and this number in here. And all of this here plus the rest of my sheet will be all calculated automatically. So it's really not a lot of work if you spend the time to create something like this. Just to recap, the Qs I have a leaning to the upside, great for bull, put, credit spreads. But I said in an uptrending market, this is probably what I want to trade. Makes you lots of money, and you can be certain when after the next recession, after the next pull down in the market, 20%, 30%, 50%, whatever, I will start selling those ones again. Right now, I'm selling bear call credit spreads and maybe iron condors in the sideways trading market. So since the IWM is very ranging in behavior, it's great for those kind of trades. And the SPY and the DIA, I think they're pretty good for iron condors. But also right now in the economic situation, I would be a little bit careful about what I'm trading. But maybe we can still be trading the iron condor. The iron condor is the same like a bull put spread plus a bear call credit spread. It's just two sides of the wing. I'm only trading right now one side of the wing. That's why it's not an iron condor. Iron condor has both. It's cheaper because since the market, when it closes or the iron condor expires or you sell it before it expires, whatever, the price, the current price of the underlying cannot be on both ends at the same time. Not in this universe. Maybe other universes, I don't know. But here can only be on one side. So one side will be always the hedge for the other side. And hence the collateral you have to come up with is cheaper. But it has a downside in this market because this market is poised for correction. So maybe you don't want to take this wing. You just keep it out. Therefore, you pay a little bit more collateral, but therefore you might be on the safer side. I don't know. Up to you.
This is all for today, my friends. The topic will be continued next time.